Good morning, Jay. Can you hear us? Chairperson Petkunas, the time is 9:30. We are ready for you to start at your discretion. Once you've called the meeting to order and the official roll call has been taken, I would like to take a moment and review the meeting guidelines. Thank you.
Sounds great. Thank you. Well, let's officially call the meeting to order and take the roll, please.
Will the following individuals please confirm they are present by stating here as I call your name? Jay Petkunas,
Here.
Tom Connolly,
Yeah.
Diane Landis,
Here.
Renee Guillen.
Here.
Chairperson Petkunas, a quorum is present. I would now like to read the guidelines and reminders. This
Thank
meeting
you.
is currently being recorded and live streamed to the public. All speakers, please remember to identify yourself before speaking. Unless you are speaking, all mics should be muted to eliminate background noise. All cell phones should be set to silent. Once motions are made, I will take the vote by roll call. Once completed, the chairperson will announce whether the motion has passed. This will ensure it is clear to the public how each trustee voted and that the minutes are documented accurately. All presenters, please refer to the page numbers of the packet found in the upper right-hand corner of each page as you move through the presentation so that attendees can follow along. If any members of the public wish to speak, you'll have the opportunity under the call to the public agenda item 7. As a reminder, if a trustee needs to leave the meeting early, please be sure to verbally indicate when you leave for the record. Thank you.
Thank you. Before I move on to agenda item number 2, I would just like to welcome trustees Conley and Guillen. Very much appreciate and are excited about your participation on the investment committee and look forward to very robust conversations. Welcome, guys.
Thank you.
Okay, let's move on to item number 2, the consent agenda. Let's see. So basically, I think we just need to call for a vote to approve the consent agenda. Do I hear any motions?
Mr. Chairman, I move to accept the consent agenda.
Thank you. Do we hear a second?
Mr. Chairman, I second the motion.
We have a motion and we have a second. Can we call for the vote?
Hearing a motion by Mr. Connolly and a second by Mr. Guillen, I'll take the roll call vote for the motion to approve the consent agenda. Please answer aye or nay when I call your name. Mr. Petkunas,
Aye.
Mr. Connolly,
Aye.
Ms. Landis,
Aye.
Mr. Guillen.
Aye.
Chairperson Petkunas, the vote has been taken.
Thank you very much. We can move on to item number 3. We've got Ms. Rose Dean from NEPC to give us a presentation on the discussion and appropriate actions regarding the investment market environment, outlook, and independent reporting, monitoring, and oversight for the period ending June 30th, 2025. Ms. Dean, welcome and thank you.
Great, thank you. For the record, Rose Dean, partner at NEPC. So I'll be presenting to you the second quarter oversight report and discuss the performance. But before that, I'll just make a few comments about the market environment. If we can move to page 14. Great. So US stocks were up about 10% during the second quarter. And you see that last column on the right-hand side, which brings the year-to-date returns back up to positive territory after the sell-off we saw during the first quarter. So year-to-date for the first half of 2025, you can see that US stocks were up about 6%. But if you go down a few rows, you see the international stock performance that we show through the MSCI indices. You see that the international stocks were up about anywhere from 10 to 20% during the first half of 2025. This outperformance versus US stocks were partially driven by the weakness in the US dollar. So when you translate international stock gains through US dollars, you see a further outperformance, but also from some rebalancing activity that brought some cash flow into the international stock markets, also giving a boost in terms of their returns versus the US stocks. This is relatively old news. So since then, during the third quarter, we continue to see strength in the stock markets and generally a very sustained appetite for risk assets. This is further supported by the Fed policy of interest rate cuts and their concerns about the potential implications of economic slowdown. Now, as of last night, we've now gone into a government shutdown, which can be a further challenge to the labor markets, partially due to furlough and potentially permanent job cuts. But historically, if you look at the market reaction to government shutdown, it's been relatively muted, anywhere from being down about 8% in the very last government shutdown we saw in the 2018s. And then following 12-month period, we've generally seen an actual increase in stock market performance. So the market seems to be relatively muted in terms of expectations of impact from this shutdown. But this is a different environment that we're facing in terms of already the cracks that we're seeing in the labor market. So speaking of which, if we can turn to page 20. So we're seeing slower than expected payroll growth, and we saw the August job report coming where the growth is remaining at a 5-year low. The sectors that are still seeing some health is healthcare and construction, but where we're seeing the weakness is in the federal government job openings, which is obviously going to be further impacted by the government shutdown. The Fed chair, when they were speaking about their plans for or their thoughts about the economy, did specifically note the weakness in the labor market. So the market is pricing in a very high probability of another 2 rate cuts within this year, which should be a tailwind for risk assets such as stock markets, but that's outside of any additional volatility driven by potentially tariffs and geopolitical issues. Interesting times, to say the least. Unless there are any questions on the market environment, I'll move to the oversight report. Perfect. So if we turn to page 27. So this is the scorecard that we bring to you on a quarterly basis. This is as of end of the second quarter, and we are bringing you the goal, whether the goals have been met by the performance that we're showing in this report according to your objectives here. So the portfolio has met objective number 1, which is maximizing the return at an acceptable rate of risk. So in terms of risk-adjusted returns, you are actually meeting the target of being among the top quartile for all periods in this report. We're also achieving returns above the actuarial rate of return for all periods, your objective number 4. And then you're also meeting your cash flow liquidity requirements, objective number 6. The rest of the objectives are met partially, and we, excuse me, we note that in this, and objective number 2, achieving top quartile returns among peers. Objective number 3, beating your strategic asset allocation policy benchmark across all time periods. And then objective number 5, the asset class returns above their respective benchmarks. So we note that these are met in the longer term, but not in the short term. And I'll go into more detail on this. But as of now, there are no actions recommended for the IC or the board.
Mr. Chairman, just kind of a thought, I don't know why this had never occurred to me, and maybe I'll throw this out there, and if I guess the investment committee, one, I think this table is a relatively new creation, and I really like it because it's it's color coded, it's easy to look and see. But one of the things that just occurred to me, because if I remember correctly, at the board meeting there was more yellow, and I kind of wonder if it would be helpful to have the last chart so you could see if there were changes. If that would be helpful to kind of see where, you know, there's improvement or where we've seen change. So I guess one, I would throw that out to my fellow board members. And maybe also I would, you know, Rose, turn to you to say, am I right in that, like, for example, I thought number 4 was partial and now it's a yes. So I guess one, maybe if that's right, and then just to throw out there to other board members, if that would be helpful to kind of see, well, what was the last report? And then I guess also to see, ask Paul what, you know, what you think about that and if that would be helpful going forward.
You are absolutely correct that the first quarter report had more yellows. This is, I would say this is sort of unusual. So when we have this partial, you can see for the past year, this is the case for the short term not meeting the objective versus the long term. And that's largely driven by this public markets performance, mostly public equities, but again, fixed income as well. And those benchmarks impact on the relative performance of the portfolio. Starting the next quarter, we are moving to the private markets peer group based benchmark for private equity and credit. That is not going to solve the issue in the short term, obviously, because historically we're still going to have this public markets benchmark. But this outsized performance of public markets asset classes is really driving this volatility in terms of meeting the objectives. So based on that, it may be informative to see whether one quarter the results will change quarter over quarter. We can certainly show the historical comparison, but I would just note that what's important here for all of us to keep in mind is the longer term performance and whether we are meeting these objectives in the longer term. And quarter over quarter, you will see this volatility. Perhaps what we can show is a separate chart, and I'm kind of talking from the top of my head, is maybe a 5-year trend of whether there have been pockets where it has not met the objectives, but I'm happy to take direction from the committee. And
well, and you raise a great point too, in a sense too, of this isn't necessarily meant to be a review. It's really and maybe I'm wrong, but it's also meant to be more sort of a canary in the coal mine of looking forward of whether or not we need to be having conversations about are we adjusting accordingly to the market going forward, right?
And whether there are issues that persist that we think are structurally embedded into the portfolio rather than sort of a relative comparison to the markets.
This is Tom Connolly. I think it's a great idea just for us to be able to see if there's anything on the surface we should dig deeper into. So, you know, I think what I was hearing is that you just want to be alerted to any changes and that might cause us to have concern prospectively, and maybe just even an asterisk or something for the items that have changed would do that.
Certainly.
And then we can dig deeper later if we need to. Thank you.
Yeah, this is Chair Petkunas. I think that's a great idea. I think it also just helps us to understand trending. So I'm not sure we need to go back 5 years, but I think at least going back a quarter or maybe, you know, a year would be helpful on a quarterly basis. I think the other issue, Rose, which you identified, is the transition from the public market benchmarks to the private market benchmarks. Clearly, when you've got a rapidly moving public market and you're benchmarking against, and you've got a primarily private market driven portfolio for PE and for debt, you know, you get a lag in that private market portfolio and that private market benchmark, right? So we're partially addressing that as we discussed with changing the benchmark, but I think seeing that just how we moved from one quarter to the next would be really helpful. The other challenge that I always deal with in these meetings is, you know, Trustee Guillen talked about the last update, which was basically March data, right? And so that's 7 months ago, and we're now talking about data that's 3 months old. I realize that with getting the accounting correct, and we just don't have time to do this, but we're already talking about information that's stale today. So Rose, I think your color in these discussions about what's happened since the end of the prior quarter is helpful as well, right? Because, just messaging where we're trending, and it feels like we've gotten better since Q1 to Q2, but we're likely getting a little better from Q2 to Q3 as well, right?
So I'll confer with staff and see what data points we can bring, but we'll certainly look to track any changes or note the changes that have happened on this scorecard versus the previous quarter.
Great.
Thank you.
Thank
One other comment I would make, if I may, on item number 4, goal number 5, the private equity and credit underperformance. Since we're changing benchmarks to peer related, we've locked in that underperformance, and
Right.
that'll take a while to get out of over time. We're confident we can. The benchmarks are appropriate. We just happen to be changing at a point in time in which public markets were high and we were pretty steady. So, but that just to let everyone know.
So I should retract my comment, wait a year and
I mean,
yeah, the timing
it'd been
is
ideal to
poor.
do it at another time. We're heroes and not zeros, but that's just the nature of it. So that's just the nature of it. So it'll just take some time to work out.
Right, yeah, that's a great point.
And
Thank you,
I-
Mr. Chairman.
I think that's a great point, and I don't think any of us intended to hamper the performance when we suggested changing the benchmark. I think the ultimate goal was to just have, we were reconciling public versus private every time we had the discussion. And I think we all will realize and give the team credit for the lag in the benchmark transition. Ultimately, I still believe that's the right answer, but we understand the implication is you're doing it at a tough time, right?
Absolutely. Thank you very much.
Okay, perfect. If we turn to page 29, just a little more detail before going into the asset class performance. This shows basically a big picture comparison in terms of universe, peer universe performance versus your own. So if you look at the total fund return for just that second quarter, it was a very strong 6% return for that 1 quarter period. For the fiscal year or the 1 year period that you see there, again, a very strong absolute return of 9.89%. But as we mentioned, the portfolio did underperform the policy benchmark return in the shorter term. And here we show that shorter term is 1 and 3 year performance. This is on a time-weighted basis, i.e., we're just rolling up all of the asset class composite performance on a time-weighted basis to get this total fund return here. So the underperformance is coming from the private equity and credit asset class against their public markets benchmark. Starting in the next report, again, we will be changing that benchmark going forward. But I want to actually turn to page 40 to look deeper into the asset class performance for these time periods so that you have a better idea of what happened during the fiscal year. Sorry for the eye chart. Hopefully you can see that on your screen better, but you can see the same information here that I just showed in the top line, which shows the total fund historical time-weighted returns. For that 1 and 3 year period, the portfolio return is about 30 basis points below the benchmark return. Where is this coming from? If you look at all of these individual asset class performance, the domestic equity, the international equity, interest rate sensitive, and real estate, you can see all of those composites for that 1 and 3 year period, they're outperforming the policy benchmark. The private equity and credit is where we're seeing the drivers of that underperformance. So the shorter term, you could not keep up with the public markets benchmark, and you can see the magnitude of the shorter term underperformance. But if you look at the long-term performance for those two asset classes and all of the other asset classes, you can see that they have been value add to the portfolio, i.e. earning additional returns versus the benchmark. But most importantly, what I want to point out here is that those two asset classes, in terms of their longer term performance, is actually helping the portfolio achieve the return above the assumed rate of return. For the 10-year period, if you look at the private equity portfolio return, it's 12.5%, and the credit portfolio is 8.6%, i.e. those extra returns above your assumed rate of returns is what's helping the total fund achieve that long-term return above your assumed rate of returns. So again, if you go back to that top line and look at those numbers in the parentheses, you see that over the 5 and 10-year period, you're in the top quartile in terms of performance, absolute performance as well. So just wanted you to have a little bit more detail and look at all of the individual asset class contribution to the total fund performance. Any questions?
Yeah, I have a question. Mike triggered a concept that I don't think any of us really contemplated or talked about deeply when we talked about transitioning from the public to private market benchmarks. My fear is that we're going to have the same discussion for the next 5 years now when we look at the trailing performance, if we're comparing part of the history to the public market benchmark and part to the private market benchmark. Is there a way to reflect the performance retroactively relative to the new benchmark? Because my concern is that we're going to have the same conversations just you know, as the market starts moving in the other direction and the public-private lag, you know, exists going the opposite way. I wonder if it wouldn't be more productive for us for private equity and for debt to show against the new benchmark, but on a historical basis.
So I understand your concern, and that is likely to be the case unless we see a significant dip in the markets and we look at how, you know, the time weighted return compares. From a prudent governance perspective, we never recommend that when a benchmark change happens, we do it retroactively, because that is actually that brings up a lot of issues, whether the benchmark change timing and the selection of benchmark is influenced by historical performance rather than a future perspective of whether this is the more appropriate benchmark going forward. Having said that, you already do have that historical perspective versus the peer group benchmark in that money weighted return page that we typically show on page 42. And it so happens that this quarter we don't show that benchmark, and I wasn't going to go into it, but I will go into it now. We typically show on this page the peer group based benchmark that we are moving towards. And you will see that historical performance versus these benchmarks for these asset classes. So you do get that information. Again, the difference here is that this will be a money weighted return figure, so IRR, versus that total fund return, which is a mix of public and private asset classes. So we actually roll that up in a time weighted basis. That's the challenge of showing the total fund return contribution.
I got it, but so by focusing on the money weighted return, we'll be able to see performance relative to the new benchmark in arrears. I don't think we should change anything. Then I just wanted to make sure we could access that information, and that's where we'll have the meaningful conversation when we talk about the underlying, you know, private equity or credit. You know, credit performance relative to the benchmark. It'll be on the money weighted returns section.
That's exactly correct. And we will show the historical performance versus those money weighted return benchmarks.
Okay. And, you know, one thing that would be helpful for the new members of the investment committee, or I guess not necessarily new members, for the re-engaged members of the investment committee, if you could just give a couple-minute overview on what we did and why we did it on the benchmarks, just so that they're up to speed on the issue, because I don't think we've talked in that level of detail at the board level.
Sure. Just the recap is the current private equity asset class benchmark is a public global stock benchmark, MSCI ACWI IMI, and it's reported on a 1 quarter lagged basis to align with the private equity valuation timing. That obviously is going to be reflecting the public markets, stock market performance versus the private equity, which is not obviously valued on a daily basis. So there is a large mismatch typically on a short-term basis due to the fact that obviously in a very strong public stock market environment, the private equity valuations will not necessarily catch up on the shorter term. And so on this page, we historically showed the Burgess Peer Group benchmark. So what other funds that are similar in terms of the universe of private equity investments have earned on a money-weighted basis, i.e. taking into account the timing of the cash flows that were invested in those strategies by those funds, and trying to compare, at least have a context for what this portfolio's private equity composite has done versus that peer universe. Similar with credit, current benchmark is the leveraged loan or publicly traded bank loan index plus a premium. Again, there has been significant strength in that market, which has contributed to the shorter term underperformance of the credit composite compared to that public benchmark. Again, we're moving to a peer group based benchmark for that composite as well. And we'll continue to show those two benchmarks historically on this page.
Thank you very much.
Mr. Chair, could I make a comment on the benchmark issue?
Absolutely.
So I'm going to speak from distant memory here to some degree, but with respect to the private equity, the change in the benchmark, my perception is that we're kind of answering two different questions with the first benchmark and the second benchmark. The second benchmark answers the question, how well are we doing against our opportunity set with selecting our investments? The first question was more of a strategic consideration. And that, if I recall, that was actually our intent a long time ago, is we had the decision of how much do we want to carve out of the public markets to invest in the private markets, and how to measure whether that's a good decision. Of course, once you're in for a long time. So once we made that decision, we were kind of locked in for some period of time. So they're really two different questions. And I don't think this is a moving the goalpost issue personally, but we are, and I'd like to have a discussion on that at some point in time at a future meeting, if you want to put the agenda on that, just to get my head around it and how we can kind of keep the strategic and the operational considerations in front of us.
I think that's a very good point. I think what you're addressing is the opportunity cost of being in the private markets versus being in public markets, and whether we're being paid enough to be in private markets. I think a good place to address that is when we review capital markets assumptions, i.e., what do we expect private equity investments to return over 10-year period versus public markets, stock markets returns. And in your decision to, and again, it just happened, so perhaps it won't come anytime soon, but when in your decision to allocate a certain portion of your capital into private markets, it's based on your expectations and the research that supports the private equity return potential versus public markets. Same thing with credit, and whether that can add value. I think the reason why I point out on a regular basis the absolute level of return that private equity has added and credit has added to this portfolio, you can see that it is on par, and if not on par, actually beating the private markets, I mean, public markets benchmark. So you do expect to earn a premium over public markets over the long term. And I think that's the table that I showed, the eye chart table we showed about the historical total fund return and historical composite return versus public markets benchmark will give you some sense. But I take your point that there are two different objectives. We need to outperform the benchmark. We also need to outperform the opportunity cost.
I think that's a great point. I think that's worthy of a future topic for discussion. And I think, Trustee Connolly, for your benefit, the issue we were facing historically was with a rapidly improving public market and the lag on the private market marks. We were just comparing apples and oranges. And you know, to your point, though, that was after we'd made the decision to be in the private markets, right? And so I think the strategic question long-term is when we come up for the next asset allocation discussion, how do we think about public versus private market versus today we're just reporting on, we've made the decision to be in the private markets and we want to benchmark, compare against a benchmark that accurately reflects that. So I think it's two issues, and I think that's definitely worthy of a discussion that we should agendize for a future date.
Perfect. I would like to actually point out on page 32, given that this is a meaningful objective in your portfolio. (32) Perfect. So this shows the risk parameter as well as risk-adjusted returns on a 5-year period, and we do have the same chart for different time periods. But I want to point out here that not only your 5-year returns at 10.39% is in the top 12th percentile amongst this peer group, and if you go down to the median return, you see that return was 8.88%, the median return in this peer group of public funds greater than $1 billion. If you look at the volatility, one measure of volatility of that return, standard deviation over the past 5 years, that's 6.89%. Again, you are in the top 12th percentile of amongst the peer universe in terms of low volatility. The median standard deviation was 8.54%. So that puts the Sharpe ratio or return per unit of risk being taken for this portfolio at 1.07. That's in the top 6th percentile. And the median Sharpe ratio was 0.7. So we'd like to put the returns in perspective of how much risk is being taken. Again, there is some depression of realized volatility due to the allocations to private markets, which are not valued on a daily basis. But again, your peers also have allocations to private markets as well. So this is another lens to look at a risk-adjusted return for the portfolio.
Mr. Chair, I have a question for the director. If looking at the total fund return over the 5 years, 10.39, or is that put us in PBI territory?
Thank you for the question, number one. Number two, we're not for this year. And what I'll say, we've just gone through a whole different set of different ways of calculating rates of return. And there's yet another way of calculating rates of return. And that is the way that the actuary will do it according to state statute in order to determine if there's a PBI. And when they do that, they'll take basically the differential between the rate of return using market value of assets and the 7%, which is at the 8%, which is in the statute for the PBI, and take that difference and only absorb approximately 1/10 of that each year. So what they end up doing is coming up with an actuarial rate of return, which will be somewhat different than what we're looking at here. So based on all that, if you put it all together, my expectation is, even though we've got a strong 1-year rate of return and a strong 10-year rate of return, at this point, there won't be, for the period ending June 30, 2025, another PBI. But you are correct if you're suggesting we're moving strongly in that direction.
Thank you.
Thank you.
Great. If we can turn to page 39. Just a quick comment here. At the end of the second quarter or the fiscal year, the portfolio value was $59.87 billion. For context, a year ago, at the end of June 2024, the portfolio value was 55.5 billion. So within this fiscal year, there was an increase in market value of 4.4 billion. So a very strong year contributing to the portfolio's objectives here. At the end of the second quarter, all asset class allocations were within allowable range with the exception of private equity. But if you look at that last column, the strategic asset allocation policy weights, this will be reflected, the next report will reflect the new asset class targets. And the private equity allocation would likely to be in that allowable range. But we'll update that starting the Q3 report. Last comment I'll make is on page 43, which is the asset class committee meetings that took place during the second quarter. There were 6 committee meetings that took place where 3 recommendations with respect to private equity managers were approved. 6 recommendations with respect to credit managers were approved, and 1 real estate recommendation was approved. With that, the portfolio, we believe, is in very good shape, and this fiscal year was a very successful one. We'll see about the future, given all the uncertainties going forward, but I'm happy to take any questions you may have.
Any questions from the group? I have one question just about how we think about the portfolio allocations given the rapidly rising, or I guess, given the volatile public equity values, right? So you know, you read the headline, we're at or above or slightly below the SAA, you know, for a specific asset class. Most of that is driven by the volatility in the public equities. And how does the team think about that, you know, when you've got either a rapidly increasing NAV on the public equity side or rapidly decreasing that impacts some of the less liquid asset classes? How do we think about that, and how do we manage to that? How much flexibility do we provide for given that volatility?
For the record, Mike Viteri, CIO. Great question. We will never be exactly on target. We'll always be going through it up or going through it down. That's just the nature of the industry we're in. That's why we end up having ranges, right? So there's a range component to it as well. If a certain asset class was to get out of range, then we'd most likely rebalance unless it was going to be hurtful to the plan. But we're looking at our asset allocation. We're looking at our cash levels on every day. We end up deciding, I think we have about $1 billion in cash right now, but it's all securitized. It's all either in Treasury futures or it's in stock futures. But with that cash, we could physically move it to another asset class, and they can invest in that direction. As a matter of fact, we just did that this last week. Our interest rate sensitive allocation actual was about 3%. We had a house view that we decided we needed to kind of move that up. So 1% was moved. So that actual is going from 3 to 4%. So we're always changing things on the margin. But it's just the nature that the volatile asset classes will really be the tail that wags the dog. So, but again, that's one reason why we end up having the ranges.
So in the short term, though, it's more about moving in and out of cash versus selling illiquids or selling, you know, public equities. It's really the big lever for you is movement of cash into other asset classes in and out potentially.
It can be. We end up having, again, as I indicated, we've got about $1 billion in master cash, but we overlay that with futures. Yeah. So that's an instrument that we can use to rebalance if we want to. We've been overweight our public equity target because we believe that's the best use of capital at that time. And we've been underweight our interest rate sensitive, which is treasuries, from 6% down to 3%, because we think it's a better use of capital to reallocate it. So when those house views change, we'll change the direction of the portfolio. But as far as the market, you know, we're not responsible for the ride, right? We're just trying to make sure the roller coaster stays on the rails. We're along for the ride at that point, but we do try to make changes as a function of our house views. Paul, any comments?
Yes, let me add to that if I can. We have monthly or more frequent, what we call tactical asset allocation meetings. They consist of myself as director, the chief investment officer, and the deputy director of the fixed income side and the deputy director of the equity side. And the purpose of those meetings is to determine whether or not we should make reallocations of capital based on one of two things. Either the portfolio is out of balance and we're not comfortable with the out of balance risk, or we have a house view and we want to move money to make it more out of balance in one direction. So those are the purpose of the meeting. By reallocating over the last decade, significantly more assets to private assets. So 50% of the portfolio is now in private investments. That actually decreases the number of levers we have to move money. So as I think Chair Pakunis is referring to, we can make strategic decisions that take at least sort of 6, 9, 12 or more months on privates. But with respect to allocating from a tactical perspective, we really have two asset classes. And it's public equities and it's interest rate sensitive. And if you've seen, the biggest movement we've had over the last several years has been interest rate sensitive, because we've on average got a strategic target of 6%. On average, we've been about 3% over the last several years. And that is so that we could reallocate capital to the public equity markets. So if you look at any point in time, we've got deviations, and the logical question from our strategic asset allocations, the logical question is how much of that is caused by market movement and how much is reflective in the house view. When we have these meetings to make that determination, sort of our key speaker at those meetings, I say, Samer, would you just put up your hand to be recognized? Samer is the Deputy Chief Investment Officer on the equity side. And one of his mandates, one of his requirements is, and one of the reasons he's sort of a key member of our team, is he has a very strong macroeconomic understanding. He will give a lot of the input and the data and the analysis. We have one other member on that team, and that's Robert Butler, and he's there to provide other insights on the risk side. And typically, those meetings end up being discussions of, we've got something like $1 billion in cash. Should we A, move it somewhere, such as to stocks, or to bonds, meaning treasuries in the interest rate sensitive? Or should we keep it in cash, which makes something like 3.75% now or 4% in our short-term investment fund? If we move the money into equities, it's typically through futures, so it's equitized into futures. But those are our levers. So they're limited to basically interest rate sensitive, cash, and public equities. And how much we can move is typically a function of how much we can take out of interest rate sensitive, or how much cash we have, and then do we equitize or de-equitize. And it's based on the key thing that we've been discussing probably for 3 years now is, number one, we had some overweights historically 3 years ago. It was in real estate. So what do? We actually levered the portfolio. We took levered positions in the portfolio so that we could have a increased public market equity allocation. So we levered at a total fund perspective. We levered slightly. I think it was, I'm going to look at Mike, it was about 1 to 2%. Is that correct, or Samer?
50 basis points.
50 basis points. Was that the maximum 50 basis points? Okay. 0.5% levered the portfolio so that we could have a public equity exposure greater than what would otherwise be doable. So that's the background. And Jay or any other committee members, if you have any further questions on that. That's the process, though, that we go through. And I'll say one other thing. The key thing that is brought up is valuations on the public equity side. So that's what is typically discussed. Why are valuations so high? And then it's typically, well, is it because growth in earnings is expected to be high? So is it a growth story, or do we expect interest rates to fall? If interest rates fall, the present value of the cash flows go up. Why are valuations where they are? And if they are high, still from an opportunity cost basis, does it make more sense to put it somewhere else, or are valuations high everywhere? That's typically the discussion.
That's really helpful. That's exactly the perspective I was looking for. Thank you.
Chair Pakunis, if I could make one comment on that, just from a governance perspective, the description that we've heard so far is still within the policy range that is allowed, determined and approved by the board and allowed. So within that range is the staff discretion to take into account these valuations and tilts.
Thank you.
Mr. Chair, I wanted to raise a question related to cash issues. on page 37, if we could go there for a moment. This is just for my own background, calibration, if you will, but on the monthly cash flows, what's the draw for on average monthly for paying pension benefits? Do we know?
800 yearly,
800 yearly?
800 divided by 12, that's our negative cash flow.
Okay,
Negative cash flow, that's not the
Right.
aggregate cash,
Right,
net,
yeah.
net.
so I was just looking at the variability of the external cash flows on this chart. And I assume some of that is capital calls for privates and
Correct. What's been happening in the last couple of years almost is we haven't had to raise any cash from public markets whatsoever. Public equity, nothing from interest rate sensitive. Private markets have been giving us a major amount of cash flow, a lot of it from private debt. Private equity was giving a lot this last year. It's been more capital calls into that asset class, and real estate has been also throwing off cash because we've been decreasing the size of that asset allocation from 3 years ago, 20 to 17, and now 17 to 15. So most of this increase in month-end balance, even though we're paying pensions, comes from just the cash flows coming from private markets.
okay,
Does that answer your question?
yeah, it does. Thank you.
If I may add, Chairman Pecunis, there is one other thing, and our external cash flows from contributions is volatile somewhat too. K through 12 is about 46% of our, about 44% of our membership. And when summer comes, a lot of the members don't pay contribution anymore. So they have the decision whether or not they get payments spread out throughout the 12-month period or a shorter period. If they pick a shorter period, they could go 2 months, for instance, in the summer, no cash is coming in from those contributions without salary. So you often will see 1 or 2 months where we have low contributions coming in compared to the other months throughout the year.
Got it. Thank you.
So on external cash flows, are you netting out contributions against pension benefit payments? Is that what I'm hearing? So that's included in that external cash flow
Yeah,
number?
I'm gonna look at Mike. That's correct.
I think on a yearly basis, we end up receiving contributions 3.2 billion. We pay out 3.9 billion. So that's where you get the 800 million, more or less, rough difference there.
Thank you.
These are net, correct?
These are
Oh,
not correct.
Yeah, everyone's not in this. These are net cash flows.
And usually the first day of the next month is when you see that cash outflow go to the pension retirement. So, but that's inclusive of the cash flow that happened that particular month. So June 2024, there would have been an outflow for a pension payment on the second or third of that month. So
And that negative net cash flow is something like $900 million a year. That's been somewhat stable over the last decade. So somewhere between 700 and a billion, 700 million and a billion of negative net cash. That means basically pension payments paid out more than what contributions are brought in. It averages something close to $1 billion a year, which is the objective. You want to pay out the idea. If this pension fund was the best, we would actually pay out way more cash flow and not bring in any cash flow. So the objective is to, and that's why we have an investment portfolio. The objective is of the investment portfolio is to mitigate contributions that are required. That's the whole difference between pre-funded, pay-as-you-go and pre-funding. Have an investment portfolio, create investment returns, you mitigate contributions coming in. The objective function is not to maximize contributions coming in. It's actually to mitigate contributions coming in.
Got it. Thank you.
That concludes the report from NEPC.
Thank you, Ms. Dean. Any questions before we move on to item number 4? Okay, let's move on to item number 4, presentation, discussion, and appropriate action regarding the asset class investment reports and preliminary total investment performance for the period ended August 31st, 2025.
fantastic. I'll have Cole Sammer and Mr. Trusiak come on up. We also have online Mr. Mike Copeland, who's at a real estate. He's in Boston in an airport, just coming back from an annual general meeting. So hopefully he's not too loud when he does his little bit. But first up will be Cole Smith for public equity. Cole, when you get the chance.
Thank you. And for the record, my name is Cole Smith, Senior Portfolio Manager here at ASRS, and I'm here to present for the total public equity asset class. So if we could start on page, excuse me, page 57, 136. Thank you. So here we present our total public equity performance as of June 30th, prior fiscal year. So we break it down into the top table, we have total public equity, and we break it down into US and then international equities in the following two tables. So regarding total public equity, we have continuing to compound these strong gains in the asset class. We posted nearly a 16% total return despite the exorbitant volatility earlier this year. So nearly 16% total return for the prior fiscal year. Now, more importantly, if we look at the longer term absolute returns, namely the 5-year, 10-year, and since inception, we're all above the 7% required rate of return for total plan, which of course is our most important objective in the long run. Regarding the excess returns, again, we made tremendous progress since we adjusted our management strategy for the portfolio about 5 to 6 years ago. So we do enhanced indexing now, where we take very little active risk, referred to as tracking error, to try to outperform and increase and compound these small but positive excess returns. Our latest achievement is the 5-year has turned positive in the trailing 5-year, which we're very proud of. And also I'd like to point out over the last 5 fiscal years, we have posted positive excess returns in each fiscal year. We are steadfast on getting that 10-year number excess positive as well. There are some strategies that we defunded that will slowly roll off. And again, we'll continue to make progress here because, these excess returns add tremendous value over time. And I think Simran wanted to speak to that just a bit here.
Good morning, Mr. Chair, members of the committee. I just one comment on this. 6 years ago, I would say, we decided to change what we do in public equity. This was, and the returns are, and the excess returns are difficult, but easy. Difficult meaning to keep them consistent, easy to show them because public equity is daily pricing. So in total, and we calculated the numbers just yesterday, we've added in value add, meaning over and above the index, by taking extremely tight tracking error risk measure of $180 million, that without gaining the returns. If we add to it gaining returns on a yearly basis for the last 5 years, that will stand at $210 million. So if we are consistent in that, in 10 years time, we should be at $500 million. That is something we're very proud about. We think it's consistent and we should keep it this way. And this quarter, it's not yet, today is the last day. We probably at half our target. So just one quarter, we are at half the target for the fiscal year. Just sorry for interrupting, Paul, but I just had to mention this. Thanks all.
Thank you.
Thank you, Simran. To wrap up this slide, I'll look at the US and international equity tables here. Thank you. So the prior fiscal year, international equities did actually outperform US equities just marginally. Now, this was driven by not only strong local market returns in most of these countries, but of course, as Rose mentioned, the significant dollar depreciation boosted total returns in those markets as well. But if you look at the longer term returns, again, the 3-year, 5-year, 10-year since inception, we see that US equities have really vastly outperformed international equities. Now, fortunately for us, our benchmark is constructed where 2/3 of the benchmark is US equities, about 1/3 is international equities. So again, as we're close to the benchmarks we're alluding to here, this US outperformance has really benefited us over the long term.
Mr. Chair, I just had a quick question on the benchmarks.
Yeah.
So you were just talking about, I assume, ACWI IMI custom, and then down below you have ACWI IMI ex-US custom. Can you just tell me what the custom refers to? I think you probably just did on the US part, but.
Oh yeah, so that refers to ex-Hong Kong, ex-China. So we've done internationally is removed Hong Kong exposure and Chinese exposure from the international benchmarks. And
with ACWI IMI custom, did you say it was a fixed?
Oh no, we
60
actually
US, 40 foreign, or?
But it's not fixed. It is truly the ACWI IMI we're tracking. The only difference between ACWI IMI and us is we just removed China and Hong Kong.
Oh, I see. So that's filtering up to.
Exactly. Just filtering it out, and then the performance trails.
Thank you.
Correct. Thank you. If no more questions, I can move on to page 59, please. All right, so here I present just some basic asset class statistics. So we see at the end of June, we were just shy of 27 billion, or nearly 45% of total plan. This asset class has managed about 2/3 of it internally across our portfolio managers like myself. The other third is managed externally by index managers like ourselves. They're also doing the enhanced indexing. On the top right, we see our portfolio versus the benchmark. And again, you can see very little deviation between our portfolio and our benchmark in both sizes and regions. So not really active tilts really to speak of there at the end of June. In the bottom left, we see the sector weights that make up the portfolio. As with prior quarters, information technology still is the largest sector in the benchmark, and thus our portfolio. That's followed by financials and industrials. And then finally, in the bottom right, we have the top 10 holdings in our portfolio. For our discussion last quarter, we did consolidate Google into one line. So now we see Alphabet listed there as a single line instead of two different Google share classes. Again, with prior quarters, names in the list pretty much remain the same. They can shuffle around a little bit. So no questions on that. I'll move on to page 61 for our house views. Thank you. So when we last presented in June, global equities were on a historic run post-Liberation Day in April. This was driven not only by some trade deals being completed, but also another quarter of very strong corporate earnings. As a matter of fact, global equities as of yesterday are up about 35% since the lows on April 8th, which is again quite the V-shaped recovery we've had here. Now, regarding the underlying composition of the equity markets, and if we rewind back to the fourth quarter of last year, we did have a strong cyclical rally that did ensue. This was led primarily by cyclical sectors such as industrials and financials. Now, however, since the lows in April, since the drawdown, it's once again the communication services sectors and the technology sectors that are leading the gains. Now, most of the Magnificent Seven that we often hear about reside in these two sectors, and the continued rollout of artificial intelligence tools and things of that nature have really driven their share prices higher. Now, they are backed by very strong fundamentals and very strong earnings growth relative to the rest of the market. However, it does lead to, it's led to quite concentration within the market cap indexes. And for example, I have a different statistic here, but if you look at the top 10 holdings in the S&P 500, they now make it 40% of the index, which is a new record. So if we look at the third paragraph, we've mentioned valuations here. So I'm referencing valuations is measured by the forward price to earnings ratio. So as of yesterday, the S&P 500 set at 23 times forward earnings. Now this is rich, nearly 30% relative to its own history. However, it's not just names like Magnificent Seven that are driving up valuations at the index level. So in fact, if you isolate the other 493 companies out of the S&P 500, you would see that their price to earnings ratio, their forward PE is sitting at 20 times, which is also, again, quite stretched relative to their history. So to Paul's point, is it certain sectors driving this? Is it earnings growth? What's driving these valuations? And the point I want to make here is the market as a whole is pushing valuations to the upper bound. And it's not just stocks associated with technology or artificial intelligence. We often hear comparisons to this tech bubble, et cetera, but the market as a whole is pushing valuations here. Something that we're wary of, we're keeping a very close eye on. And I do want to make a point here. I mentioned this last time. Rich valuations such as these are poor predictors of returns in the short run. A rich PE like we're seeing here doesn't necessitate price mean reversion at the index level. But what it does do, it makes equities much more sensitive to risk-off events. It leaves us much more vulnerable to corrections like we experienced, earlier this year in January, February, then of course the big drawdown in April. So again, something we're keeping a very close eye on. We debate this daily on where valuations are, where we think we're headed from here. Looking ahead, both earnings and price targets for public equities have been revised significantly this year. As a matter of fact, since I put this slide together on September 10th, we've had quite a few revisions since then. Currently, the S&P is expected to end the year at 6,800. That's a median consensus target. Earnings are expected to grow about 9% this calendar year. If you rewind back and look at where these targets were, in January or February, we're meaningfully higher now with these targets. Now, 6,800 on the S&P is only about, less than 2% higher from where we sit currently. So certainly these can be achieved, these targets can be achieved, but we're going to need considerable clarity on trade and these other major policy decisions for these companies to properly plan and execute. So those are the house views I have for now. If there's any questions, please feel free to ask.
Mr. Chair, I have a question on the domestic market, not the market per se, but my impression in the past was that we had a belief, implicit or explicit, that any economic downturn or market downturn would be at least partially mitigated by responses by the Federal Reserve and the fiscal authorities in trying, the so-called Fed put. Where do you stand on that today?
I'll share my opinion. I'll let Samar share his as well. The Fed's in a precarious position, to say the least. With the market being as lofty as it is now, I think the Fed put probably has less credence than it did in the past. And there's a lot of questions of central bank independence as well that's playing into this. So, we do believe if rates do come down, that will support valuations in the short term. Now, in the long run, where does that play in? We're not quite so sure. Because even with the Fed put, valuations are rich. And so, if markets do start to come down and Fed eases, that could keep things where they are. But I don't think we have the strength of the Fed put as we had, say, maybe 5 to 10 years ago, just given where the price levels are. Samar, do you want to add anything to that?
I would add one point, and I think the Fed put is still in place. If you look at the Fed balance sheet, we're still at 4 times the level of the balance sheet that we saw in 2008, pre-2008. So the Fed put naturally is present. Now, the Federal Reserve is partially selling in the market on treasuries. Sometimes they just let them redeem themselves. But my belief, or our belief, is this put is naturally there, and I would say might come again if things go really bad. But going from $4 billion balance sheet to $1 billion balance sheet is not going to happen tomorrow. It will take so much time.
Closely, I guess it would depend on the drawdown, right? If we get a major drawdown and the Fed eases, the Fed puts there 100%. But if we're lowering 25 basis points, at a time, and then we put on pause, there's not much relevance like it used to have there.
Yeah, I guess the reason I'm asking the question is, the short-term volatility we haven't really been too concerned about, but sometimes historically when you have valuations past a certain level, that can be a long-term impairment in the value of the market, which might have consequences for us. So that's the reason I'm asking the question.
Yep, 100% agree. Yeah, in the short run, like I said, poor predictors, but in the long run, yes, there's concerns about these valuations. No more questions. I do want to take a quick sec to introduce Brian Shao. So just want to make note of this for the committee. Brian Shao joined our team about a month ago as an analyst. So I just want to let you guys know that Brian has joined us. He's going to be instrumental to the team. Brian, if you want to wave your hand there. So again, Brian joined as an analyst, instrumental to the team. So thank you for joining, Brian. If you guys have any questions, let me know. Otherwise, I will conclude here.
No questions. Thank you.
Samar?
Good morning, Mr. Chair, again, and the members of the committee. For the record, my name is Samar Gardar. I will be presenting now private equity, and I won't go again into performance because Rose went through it, but I will go to slide 67, which is cash flows. So on this slide, it shows that how the portfolio have matured naturally over the time, especially post 2019. And even when the market was, I would say, in the worst cycle for private equity, which is 22, 23, 24, we still were almost even on capital calls versus distributions. This year is slightly different, and we had a great first quarter, which is Q1, but towards the end of the quarter, there was a slowdown in activity, given the perception that the administration will have a policy on tariffs. And I would say Q2 was almost April, May standstill, nothing happened, no activity on capital calls or distributions. So we did see a drop in capital in distributions. On the capital calls, sorry.
Mr. Chair, I have a question briefly. Samar, so in 2025 here, we can see the delta. in any given year on average, what do the distributions look like throughout the year? Is there lumpiness from one quarter to another? So when we look at this from quarter to quarter, do we assume that things are uniform throughout the year, quarter by quarter, or are they somewhat?
I would say uniform. Usually, the summer is slow. But there's one element that is extremely important, which is we introduced a co-investment program in 2023, late 2023, and the co-investment program is deployed on the spot, meaning we commit X amount, that amount is invested in that year. It's not like a fund. A fund, you commit $100 million, is invested over 4 or 5 years, so the capital calls will be distributed. So this year in particular, you see that the delta is mainly the co-investment program because we took our manager with our participation, took advantage of the market and deployed a decent amount. However, if you see Q3 now, I would say activity never been better. Honestly, a lot of it have been delayed from Q2 to Q3, but I would say even historically, it's probably the best summer if we take out 2021, because 2021 is exceptional, which is post-COVID. 2020 and 2021 should be always averaged down as if like they're 1 year. But I would say activity has been robust. Even the returns, I would say we should be back for next fiscal year at double-digit returns, something that have been difficult the last 3 years. That's in general.
Thank you.
If we move now to
One comment I'd like to key on, Samer mentioned it's a mature portfolio, and it is. If you look at the earlier years, 2007, 2008, you'll see a lot of red there, right? A lot of money going in. That's kind of the J curve. A lot of contributions, a lot of investment, not getting much in the way of return. And return here is the orange or the yellow. So as time goes on, the portfolios mature, we start seeing the distributions evening out or even exceeding the contributions. So that's an indication, with the exception of COVID, that's an indication of a more mature portfolio. So, and now it's over the last couple of years, it's been the IPO market kind of frozen up. Most of the activities happen in private equity. I think Sam will get into it. Sales have really been happening to other sponsors. So private equity selling to private equity, or private equity selling to strategics, but nothing in the way of IPOs. But we're starting to see some green shoots in IPO space. I'm sorry. Thank you.
no problem. We can go to slide number 17.
6.
Yeah, it's 17. Yes,
I got it.
yeah, I got it. So I just want to give a slight background on our strategy. So we changed our strategy, and it takes time to tilt a portfolio like private equity. But I would say our strategy focuses on the mid-market, both the upper mid-market and the lower mid-market, and even the mid of the mid-market. We believe there's a lot of opportunities of improvement in these type of companies. Probably and plus it is the largest number of companies in the US. We're talking about tens of thousands of companies, and I will go into explanation in few points. The sectors that we are, I would say the top sectors we're invested in are technology, healthcare, and industrials. Technology, we're almost the same as the market. Healthcare, we're slightly higher. And with healthcare, we are very selective on what we invest. We try not to invest with anything related to the cycle of administration, meaning if Medicare is affected or not affected, doesn't affect our investments. On the industrial side as well, the portfolio have done very well on the industrial, and we believe this is a go-forward strategy. And we are ahead of the market given the fact that America is going back to a push on the industrial level. I will move to point 3. So as I mentioned earlier, 2022, 2023 were very difficult. We saw some recovery in 2024, but I would say the best recovery we saw is Q1 2025. And as I mentioned earlier, there was a slowdown in Q2. We think this is behind us. And the main issue here is private assets had a lot of fat. I'm sorry to use that term, but with zero interest rates from 2008 to late 20s, there was a lot of players in the market. And I would say there was a statement a couple of days ago by a private equity guru said, we have almost 6,000 GPs in America, they should be at 3,000. And that is the main issue. We had a lot of players that were doing financial engineering, and betting, you borrow technically at zero, you pay a premium and you invest whatever you get in returns, you're making a lot of money. So that correction, meaning that the rates going from that level, from the 75 basis points to the 5%, did a lot of damage for private equity, and that's natural. We think this should be behind us on a go-forward basis. As Mike mentioned, IPO have been slow the last 3 years. This year, there's a comeback, but I would say mainly in certain segments of the market. But what we like about the mid-market, it is not dependent on exits on the public market. So public market is down or up, it doesn't affect us because the mid-market, especially lower mid-market, is selling to other private equity firms, the larger ones, the upper mid-market, as well as to strategic players. So strategic players on the exit side play an instrumental level on the level of transactions and exit. At the same time, the mid-market plays the opposite, which is the carve out. They take small portions of companies that are big conglomerate and they carve it out into a smaller company. And this is where we think is a sweet spot for us. I want just to go back to a point the committee spoke with Rose about, which is private markets per se versus public markets. We have I would say a trend in America for the last 25 years, which is the drop in number of listed companies in the stock market. And now we are less than 5,000 stocks. That number 20 years ago was probably double. The main issue now, we saw the president talking about it, mainly trying to lower the regulation on the quarterly reporting versus semi-annually. But I would say the requirements of the regulators is too high and it's too expensive, so companies prefer to stay private. So private companies are becoming more and more big, and there's more, valuations are not helping now, but there's a lot of take private companies. Yesterday, there was one of the largest take private probably in the history of the stock market. So we believe that this is here to stay. The private companies in the mid-market, as I said, probably above 15,000 companies, and they are a big part of the market, and they are an asset class. And now we hear that so people don't speak again about private markets. Now they talk about private equity as an asset class. We believe this asset class is here to stay because of the nature of the economy and the changing dynamics. And lastly, the last point I want to mention here, which is there was an executive order by the president, which is to allow the 401ks or the retirement account to invest in private equity. We think this is one of the biggest things that ever happened to this asset class, and projections that would be around $1 trillion, which is almost, I would say, a fifth of the market. So that will be a big thing for liquidity, for the asset class to stabilize. And hopefully that will go through, and we'll talk about it more in the future.
Mr. Chairman, I have a question on that exactly. So when I read about that, I thought, oh, that's pretty incredible, but that's more people chasing than the money that we're chasing. And so how's that going to affect us?
I would say and I'm trying to choose my words. I'm hoping that they don't create an evergreen structures where they dump things they don't like in these structures. That's my concern for the families and investors that don't know. For us, it doesn't affect us. Actually, it creates more liquidity in the market. So markets we had a high investment cycle in pre-COVID and post-COVID. And it stagnated in terms of exits. It looked more or less like 2008. So what we invested in private equity in 2005, 2006, it stayed for a long time where exits weren't happening. This time around, I would say it's the same level, but something is changing. So what's changing is innovation, what we call now continuation vehicles, which is secondary markets, LPs like us selling in the market, and the GPs taking to the market's existing investors. I would say a third one would be this type of 401k type evergreen structures that will be sold to individuals. Hopefully those would be good assets and they don't use it as a venue to dump assets that are not high quality.
You're starting to see the large private equity players introduce these types of funds, democratizing private equity for the retail market. So generally, there will be some competition for deals. I believe there'll be competition for deals. They're going to be generating more returns on the 401k side, to retail side. They're going to be charging more. There's going to be more fees. So I think they're going to be cognizant of what that performance record looks like relative to the institutional one, because everyone's chasing it because of the institutional track record, right? They need to produce on that side, net all the fees. So it needs to be reasonable. So, but my belief is that there will be competition. But again, as Samer indicated, public market securities aren't as robust. There aren't as many of them as there used to be 10 years ago. The Russell 2000, I don't think has 2,000 stocks in it. I think it's about 1,700 because there's just not enough. The small companies are not listing because it's so expensive. It's so onerous for them. So when you don't have small cap stocks, there's not a chance for them to grow until mid cap stocks or large cap stocks, right? So it's being cut off at the bottom. I think there will be competition, but I think it'll be healthy competition.
Chairman Kunis, just by way of background, for all members, you probably know we run the equivalent to 401ks here. So we have over $2 billion in assets under a 457, 403B, and 401ADC and DB. So we have, let's call it 4 different types of defined contribution plans in excess of $2 billion. And in that, because of that, we are also a member of something called NAGDA. So the National Association of Government Defined Contribution Plans, and they just had a conference in San Diego. And Robert Butler, if you could put your hand up, he just spoke on this topic at that conference. So we've got fairly well-developed thoughts on privates in defined contribution plans. And if you'd like to share or have a meeting on this with them, maybe myself and Robert at any time. I'll give you the theme at the conference on this particular topic that Robert and some colleagues spoke on. The theme seemed to be about such things. Number one, there were evergreen propositions. So evergreen what came out is a strong approach. How assets going to be valued, obviously in the today's and values, and whether there's secondary valuations. In other words, a GP does a valuation and some vendor in between does more periodic valuations, which could be not consistent. And then also not just putting private equity into this allocation, but other private assets, which could be like infrastructure, real estate, and so forth. So it could be a bundled approach. And the perspective seems to be that the first area that these may find themselves won't be in standalone entities. In other words, if you're a 401k purchaser, like a member, a participant, what's called a participant. If you're a 401k participant, you can buy, say, a large cap mutual fund and a small cap and a fixed income fund and so forth. The entrance is likely not going to be private equity. The entrance is likely going to be if you have a risk profile fund or a retirement date fund. So it's a pre-distributed or asset allocated fund. So you go in there and you say, I'm born in such and such a year. That means I need to go into a 2045 retirement date fund. And therefore it's going to have this asset allocation to it. This asset allocation will then have a part of that will be a 10% allocation to privates. That's likely how it's going to find its way in.
Mr. Chair, I had a question on the IPO market. I heard what you had to say, that our typical exits are to other PE players or strategics. Nonetheless, historically there's been exits in the IPO market. And my question simply is, given the low level of activity until very recently in the IPO market, looking at the valuations, if not now, when? I mean, why is the IPO activity so low when the public market multiples are so high? And why would we expect that to change? And why isn't it changing to be more exits via the IPO market? I just want to get your thoughts on that.
I would say the regulation is extremely difficult. If you ask any CEO, would you rather be public or private? I would say 95% would say private. Reporting on a quarterly basis is difficult. if you are in mid-cap companies, you have to do analyst calls, you have to answer a lot of, it's very expensive. So there might be a way, and I do see the administration trying to lower the quarterly to semi-annually. I'm not sure if it will pass, but it might be a good way to allow more companies to be listed. I think capital markets in America are probably the best asset we ever have. Like globally, no one compares. The depth, the liquidity, the regulation, but the thing is, it is difficult to list. And now, if you talking about the mega cap private equity and the large cap, there's no exit except a listing. And we will see more assets being listed. It's just a matter of time. And I just believe that the slow activity in private equity the last 3 years did not allow managers to even think about listing. They just had so much on hand to deal with things. There's a lot of policy headwinds, which is the tariffs are not clear. So there's a lot to do before you take a company public. But I would say they will come back. Now we saw what we saw now is recently the successful IPOs, especially in the technology. It's a matter of time. It will come, but I would say more on the larger companies. The smaller companies prefer to be private, unfortunately. Mr. Chair, if there's no more questions, I've concluded my section.
Thank you, Saber. Next, we'll go to Mike Copeland, who's in the Boston airport. Mike?
Yes, thank you, Mike. Apologies for not being able to be there in person and for any background noise you might hear. So if you go to page 75, please. So on the performance, one thing I just want to indicate is articulate is the significant outperformance across all time periods. You get on a 10-year with the portfolio outperforming by over 150 basis points. There's a comment earlier about the lag. I think quarter over quarter, looking to June 30 valuations, the real estate portfolio is expected to be more or less flat, plus or minus 25 basis points or so, given the appraisal cycle is on the 331. If you flip to page 76, please. So this is the cash flow. And through yesterday, the real estate portfolio has produced a significant amount of positive cash flow this year. Net positive cash flow close to $800 million. And as you'll recall, as the committee will recall, we moved the private debt to the funds from the private real estate debt funds that were in the real estate portfolio to the credit portfolio that was effectuated on 7/1, which accounted for about $400 million of the $800 million. And that through yesterday, our allocation to real estate is at 15.4% of total fund. So pretty quick movement from the previous target of 17% to the current target of 16%. If you can go to the slide 77. So from an allocation perspective, we are overweight the Sun Belt, which would be Southeast, Southwest, Mountain. Slightly underweight Pacific, mainly underweight Portland, as well as California. Relative to the benchmark, the non-US exposure of 9% is mostly a European debt fund that was moved to the credit portfolio. So you'll see that in the coming quarters reduced by more than half. Otherwise, it's a triple net lease strategy that with a majority of exposure in UK, as well as Spain, Italy, Germany, and Scandinavia. And then the various of the 4% is comprised of our 3 operating company investments, which are equity investments. You move to the next slide, 78. As you recall, we have a target to residential of 50%. So we're relatively close to that. In the industrial, we have sold assets as well as raised significant amount of cash flow through a CMBS transaction, which reduced the exposure. We have allocated additional capital to industrial to acquire new assets. And then the other is comprised of mostly data centers, but also healthcare assets and hotels. If you can go to slide 80. Looking forward, I'm sure the committee members have seen headlines regarding the amount of new supply and multifamily new construction activity that it's delivered over the last 2 years. And that's true. Last year was a record in new supply for multifamily. But one thing that's underreported is the fact that it was a record year for absorption across that new supply and across really all markets that we're active in. And we expect 2025 to set a new record for absorption, which with the construction activity decreasing so rapidly and significantly, we think that rent growth will turn positive next year, later this year and next year. And we're seeing it in our portfolio where there has been less new supply and the absorption is happening. We're seeing increased rent growth. In the industrial space, which is the other main exposure within the portfolio, there's a bifurcation depending on size. So similar impacts of new supply as multifamily, but in the industrial space, the larger boxes, so the 800,000 square foot or larger, very low supply that's been largely absorbed by tenants. But there is an excess supply of the 200 to 600,000 square foot industrial warehouse that has been delivered. And then it's warehouse. The industrial market has also been hit with the uncertainties regarding tariffs. This is the major impact on that is the Inland Empire, which is the Port of Los Angeles. Tenant demand has been soft, and you've seen rent growth decrease by 20% year over year. Within our portfolio, despite that rent growth decrease, there's a significant amount of value to be created because the industrial rents in the Inland Empire more than doubled over the 3 years between 2019 to 2023. And there's a significant amount of value increase from remarketing the rents. And so our releasing spreads, so the difference between current rent versus the rent you reset at with either the existing tenant or with a new tenant in our portfolio is between 40 and 50% in the Inland Empire, which will result in increased values over the next 12 to 24 months. And then I think that transaction activity is still low, but it's increasing off the bottoms. And the debt markets that I was in an annual meeting this morning with our hotel manager. Debt markets is widely available. Their comment was it hasn't been this active since the last 15 years. They not only are you seeing private debt funds, but you're also seeing money center banks, regional banks. The CMBS market is open, and that's allowing some transactions to increase. You add in the Fed decreasing the funds rate with the expectation of another increase or two over the next 6 to 9 months, and that should also result in continued recovery within the real estate market. I did want to also point out that over the next 12 to 18 months, we think that the returns in the real estate portfolio are going to increase. There is a large amount of value that will be created in profits from our data center developments. As those assets are, the office assets are demolished and then data centers are built and leased, as well as the industrial assets of remarketing the rents to market. Happy to answer any questions.
I have none. Anybody else in the group have questions? Mike?
Mr. Chair, I just had one. I see apartments a big player in the real estate exposure. And it seems like families are pretty much up against it with respect to buying houses, with rates high and housing values having gone up. And then in the rental markets, it seems like the rental component of disposable income is pretty high. Do you think that there'll be enough wage increase capacity in the economy to support rental increases in multifamily going forward? It seems like to me that's from what I read, that's a little tight, and further increases in rents might be really dependent on wage growth.
Thank you for the question. I think it's a very good point. Our apartment exposure, and I'd really categorize it as rental housing exposure, is really 4 components to it. The first is the new development Class A multifamily, which are targeting renters with incomes of 80% or up to like 120% or higher of the median income in that area. And in that portfolio, our manager does track the income to rent ratio, very robust credit checks, and across that portfolio, in aggregate, the rate is less than 25%. I think it's like 22% from the last board meeting, which is pretty healthy and a sign of the ability to push rents when the market is more in balance between supply and demand. On the second component is our value add acquisition strategy, which is targeting the 50 to 80% of incomes. And we have seen in some markets, specific assets, a rent ceiling. And so we have taken advantage of affordable tax programs within those submarkets, which also allows for more favorable debt financing to create value and also be able to sell to there are a number of affordable housing funds that have been raised, and so we're capitalizing on that without jacking up rents on people and that are facing those issues. And then the last component is senior housing, which is I think the supply and demand is really why we want a 50% target to housing. The senior housing is similar, where there's just a lack of supply for the need. And it's a more operationally intensive asset, a property type. So you're able to push rents, but our managers are always cognizant of pressures they may be putting on, and they're not forcing people out, but it's also an industry that's facing wage pressures, and so there's the cost to provide that the services and housing to those folks.
Mike, one other point to add there is the gap between the cost to own a home and the cost to rent a home is the largest it's been in 25 years. So while you're right that the cost for homeownership is prohibitive for new home buyers, that gap between the cost to rent and the cost to own is significant, and that signals generally that there's room to move rents pretty significantly. Obviously, rents and nominal incomes kind of move consistently. They're very highly correlated. So you're to the extent you expect income declines, that could bode negatively badly for rent growth. But I think there's a lot of room for rent growth on the apartment side, and I love the allocation in the portfolio of 43%. My quick question for you on that 43%, how much of that is the OpCo versus the underlying real estate? You showed those strong returns on the OpCo IRRs. How much of that is our captive OpCo versus the actual underlying real estate?
So the OpCo investments are captured in the other category outside of the property types.
Great.
And it is about 4.5% of the total portfolio.
Thank you.
Chair Pecunis, let me just ask Mike Copeland a follow-up if I may. Jay, were you asking out of the OpCos, what percentage of the valuation is underlying assets versus the operating company?
No, I saw on a prior slide that something like 43% of the asset allocation was for rent residential, and I was trying to determine whether the operating company, which I know we have an interest in a multifamily operator, whether that was included in the 43%. I think Mike answered the question that's in the other bucket. Is that right, Mike?
That's correct.
Thanks. Any more questions, Mike?
Thank you very much, Mike. Safe travels home. Next, we'll have credit and then interest rate sensitive. So Al Limo's out of the office on vacation. We're gonna have John Trusiak pinch it for him, although that's really not accurate. John is actually a co-portfolio manager on the credit side. He's been underwriting all the investments we've been doing for really this year. We have a very informed speaker. So John, if you could take it away in credit and then interest rate sensitive. Thank you.
Thanks, Mike. Hello, everybody. John Trusiak, portfolio manager for private credit and public fixed income. We can turn to slide 84, please. Thank you. So I know NEPC touched on the performance for the alternatives, but I'll retouch on it since that was maybe an hour or so ago. But for the private credit asset class, for the 3-month period, obviously lagged. So we're looking at 3/31 numbers. We did outperform our public benchmark, which is the Morningstar LSTA Leveraged Loan Index. That's been the benchmark for the time being. I know we've discussed how that will be changing effective July 1. But we did outperform for those 3 months. But looking at the 1 and 3-year period, the credit asset class did perform over a 7% return, although it did lag its public peer benchmark. We do add a 250 bips illiquidity premium to our public peer benchmark. So that's where you're kind of seeing those returns that were not excess of the benchmark. A couple of things to note here is the leveraged loan index has really rallied over the last couple of years. The average loan price in the leveraged loan index is at all-time highs. It's near par, over 99% as a percent of par, where historically it's kind of been in the mid to 90s. The actual loans in that benchmark, and then would also generate return via the yield component. So that's what's happened in the benchmark that we've been tracked against. And then within our overall credit portfolio over the last couple of years, we have seen a higher number of defaults as we've seen in the past. Recovery values have come down. And that's just really a function of the M&A market not being open for the last couple of years. You know, when there's a distressed credit in a loan book or that we're invested in, if that manager were to take back the equity, they would try to work it out and then exit the name. And that M&A market has just not really existed over the last couple of years. So that's where we're seeing some write downs in the credit portfolio. But overall, yes.
Mr. Chair, I have a quick question here. So how do you define when we read these reports, the word default is a default like a Chapter 7 equivalent event, or is it modifying the contract?
Yes. Yes, and each manager has different nomenclature for default because they could amend a maturity that was up against the wall, but the credit is still paying, and they would not classify that as a default, or at least most of our managers weren't.
But a public market definition would classify that as a default, right?
It would actually classify that as an amended loan. So no, it would, in the benchmark, the leverage loan index benchmark, that would not be a technical default in our leverage loan benchmark, as far as I know. What our managers classify as a default. Oh, yes. Oh, sorry. Oh, sorry. I thought you raised your hand. Oh, okay. Sorry. Apologies. What our managers mainly classify a default is a covenant default or a non-payment default or maturity default.
All right, so that even if there's a subsequent workout of extension of maturity or
An extension of
whatever.
maturity, most of our managers are not counting that as a default if the loan is continuing to pay.
So your use of the word would correspond to those definitions?
That's correct.
Okay, thank you.
Thank you for the question. So anyhow, those are the main reasons in the credit asset class is faltered from its 10-year return where we saw a net return close to 9%. Now it's at 8.63%. But even though the long-term outlook on this asset class is the new partnerships we're underwriting, we see double-digit net returns for this asset class, and this is a very mature asset class that we have here. We've started investing in it decades plus ago, and with that, we have partnerships in place that have had some credits that went through a restructuring or a workout that are still on, still in the loan portfolio, and our credit managers are actively trying to exit those positions, but we need an M&A market to open up a little more. It has opened up in this quarter, this Q3, and we see M&A becoming more transactive. And then with that, if we could skip ahead 2 slides, please. So this is something I wanted to point out, and something I know that Samer touched on with private equity, but you can really see the current maturity and the cash flow that the credit asset class is producing for the total fund. Since 2021, we've really been either break even or producing massive amounts of net cash flow into our total fund. In 2024, we basically had contributions or capital calls of 1.75 billion, but we brought back in distributions of close to 2.7 billion. The very last 2 bars, you can see that's an LTM. So that's not just for the stub year 2025, and these are calendar years. But you can see that trend is continuing, and we expect it to continue for this asset class to produce near $1 billion of net cash flow for the total fund. Moving on to the next slide, please. And then Alan, I wanted to touch on this slide. You can see where we're mostly exposed in the credit asset class. Over 50% of it is to either US or European corporate private debt, which is basically your direct lending type strategies. Historically, these two aggregated to a total closer to 60%. We've been working to diversify into other strategies within the credit asset class. Like asset-based finance is something that we have just added to our roster. And then other niche strategies that would fit in this credit asset class that have exposure to other types of loans, being it corporate loans or niche, aviation type leasing, shipbuilding type finance. So we're working to continue to diversify the credit asset class where from this larger direct lending that is kind of overtaken credit as a whole, private credit as a whole. And then I'll move on to our house views. So overall, the private credit asset class, it continues to produce a return north of 7%. So hitting our total fund return objective. We believe that this asset class can maintain to outperform that 7% number. In fact, like I said, the new partnerships we're underwriting and looking at are double-digit net returns. You can see that as of quarter end, we were at about a 20.5% asset allocation to the credit asset class, just over $12 billion. Our target is 22% with the new SAA. The reason for a little bit of that is we had slower deployments than we expected. And then also most of our managers use a subscription line where basically they're using our commitment to fund capital calls. It delays our capital call for upwards to 365 days. So we expect this 20.5% number for credit as a whole, as a percentage of total fund to creep up to 22%. And of course, public equities has rallied as well, which changes that denominator number, as has been pointed out during this meeting. But overall, there are a lot more competitors in this space. There's a lot more private credit managers. There's a lot of money coming into private credit. It is an asset class now that has a household name in institutional allocation. And it's not just institutional investors either. There's a lot of high net worth being raised to this asset class, a lot of RIA fundraising as well, which we would continue to monitor and continue to see how this affects the asset class. But overall, we do expect this asset class to continue hitting our return objectives and being a strong diversifier for the total fund. And with that, I'll take any questions. Thank you.
Any questions from the group? I've got you mentioned that a number of the managers are using subscription lines to basically defer capital calls, which makes sense. How much back leverage beyond the subscription lines are you seeing in these sponsor vehicles, if any?
Yes. So we are well within our guidelines on basically the back leverage or kind of fund financing. But we have some managers that do use that type of financing that we allow within our partnership, but it's not a number that is more than even 35% of total credit assets within that fund. So it's well within our guidelines and regulations, and some managers opt not to use it at all. Some managers can obviously use it accretively to enhance the return. So it just depends on the type of strategy that we're invested in. But yes, it is present, but not at a number that is, it's well within our guidelines.
And when you're benchmarking one manager versus another, are you kind of de-levering that back leverage to compare it kind of apples to apples, or is it really just a case-by-case assessment of kind of those leverage levels?
Yeah, it depends on basically the bucket of that manager, meaning if you have a manager, if we have a partnership that has 150 names within our loan portfolio, that's a highly diversified loan portfolio that we are positive can attract good financing partners to accretively enhance that return, and it's well diversified. But in some of our other partnerships, they're not that diversified. That's not the strategy fit, and they're not as easily financeable from a bank that does that type of financing or an insurance company. So case by case basis to answer your question.
Got it. Thank you. Okay, if there are no more questions, I think we can move on to interest rate sensitive.
Thank you.
Thank you.
Yep, and I will also take that presentation if we can please turn to slide 93. Thank you. So interest rate sensitive, also the portfolio manager for that public fixed income, John Truziak, just a reminder. So we have seen continued outperformance versus our benchmark for this asset class, as you can see in the excess returns. However, what we want to note here is you can see, the 1 year, 5 year returns just come nowhere close to our 7% objective for total return. This asset class has been highly volatile over the last couple of years with interest rate increases, Federal Reserve increases, just interest rate sensitivity, volatility. So that is a reason why this asset class sits, near the bottom end of its range for its SAA goal. Currently, at the end of this quarter that we're looking at, 6/30, we were right at our 3% allocation, which is the bottom end of our range. But important things to note is it is 97% internally managed. I'm, actively trading this asset class and making sure it adheres to the tracking error that we are allocated and generating excess returns where we can. Next slide, please. What I do want to draw everyone's attention to is the bottom two tables on this slide. So you can see that benchmark yield to maturity since 2022, it's basically had a 4 handle in front of it. As of June 2025, the yield to maturity on our benchmark was basically at 4%. I checked it this morning. We're now sub 4%. So that just gives you an idea of how, where interest rates, at least on U.S. Treasuries, that is our benchmark, are basically adhering to with regards to the yield. And then for portfolio sector weights, we really are in a treasury type portfolio with, call it 10% allocated to corporate bonds. I should mention corporate bonds are at all-time tights with regards to option adjusted spread. So it's something, where we've received excess return from owning those securities that are outside our benchmark, which we're allowed to own. But at the end of the day, from a relative valuation standpoint, we are very much monitoring how corporate bonds are moving with regards to spread. And then if we can skip ahead 2 slides. And unless anybody has any questions, I'll continue on to house views. Thank you. Not hearing any. So like I mentioned, the interest rate sensitive asset class, 6% SA target. We were at 3%. Mike Viteri mentioned earlier that, with our tactical asset allocation meetings, we are tactically asset allocating on the margin where to put some excess cash. Like this asset class did receive a contribution to it in this quarter, which we allocated. So that 3% number where we were at to end the last quarter will go up to closer to 4%. But overall, it's still not meeting our 7% target return for the total fund. We view it as a good diversifier. It's good to have if we do need liquidity or to move around this asset allocation weight to other areas where we see more accretive returns, where we can maybe jump on an opportunity. So with that, I will leave it up to any other questions, and thank you for the time. Thank you.
Thank you.
John, turn to page 98, please. I always want to key in on our investment operations team. Given that we're 50% private markets, this team is constantly working. It's always a big lift when you've got private markets. There are mid-office, there are back office. James is here today. Raise your hand, James. Lupita's at NAGDA. She's a big lifter on the defined contribution. She's kind of, it's a major project manager there. But this team is constantly busy. So just a shout out to them and kudos. Without them, we'd have a hard time investing in private markets. So thank you very much. We're going to page 99. I'm sorry, page 100. This preliminary performance through 8/31/2025. These are pretty much final numbers, but at the time we published this, it was still preliminary. Total, just three things to highlight. Market value is 16.6 billion. So we crested over the $60 billion mark. That continues. If you look at a 1 year, 3 year, 5 year, 10 year, and 20-year basis, we're above 7%, and since inception at 8%. So exceeding our actuarial assumption rate, which is pretty much one of the most important things we're able to do. And then if you look at the excess returns, positive performance for the 5, 10, and 20-year and since inception date period, underperformance for the 1 and 3 year. But again, we've kind of beat that horse to death. It really is a function of the public market benchmarks relative to our private market implementation in that space. So other than that, that concludes our formal remarks.
Okay, any questions from anybody in the group for the rest of, for the team? With that, I think we can move on to item number 5, the presentation, discussion, and appropriate actions regarding risk analysis and investment compliance. Mr. Butler.
All right, thanks. For the record, Robert Butler, Investment Risk and Compliance Officer. I guess this is the start of the informal part of the presentation. But, sorry, so next page, 108, or no, sorry, 103. Got excited and thrown off by Mike's comment. So as a reminder, like most of the information that we've seen today, this report is based on our holdings as of 6/30/2025. And here I'll just note, and this will come up again later, and you may have seen it in Cole's presentation. But as at the time of this report, NVIDIA was our largest individual equity holding, but in the previous reports for a while, it had been Apple. But just, so I wanted to point out that change thanks to the growth in AI. And then if there's no questions on our investment risk philosophy, I'll go ahead and skip to page 108. And here I want to give a little bit of, love to interest rate sensitive, despite the lower return than our target of 7%. This kind of highlights why we include it in the portfolio in this correlation report, showing that the movement is not highly correlated with our other assets, which provides a lot of diversification benefits. And, often it's a port in the storm when things get a little scary out there. And as has been mentioned a few times, it's a very liquid asset class, so it does allow us to do some rebalancing to take advantage of opportunities or meet capital calls. Yes.
Mr. Chair, Tom Connolly here. On the correlation report here, you have credit. What does that mean? Is that a?
That's our private credit portfolio. As one.
Right, but is that actually a private credit?
This is based
series
on
of returns or public
investments.
Actual. Okay, yes. Thank you.
Sure. And this report, as you'll notice, MSCI down on the bottom right. So this was the analytics were done with the MSCI's Borrow One system. And so that's like all the analytics in the first part of my report are done working with MSCI's Borrow One system. And then the rest of it, that's more sort of just stats on our largest managers. That's just me pulling information from other systems that we use. Right. Flip to the next page. Again, this was done with the MSCI Borrow One system. On the left-hand side, we show our asset allocation based on dollars invested. The right-hand side shows the contribution to volatility from those investments. And you'll see that both public equity and private equity contribute the bulk of the volatility in our portfolio. However, even at the slightly over 81%, that is much lower than what you would see with a sort of classic 60-40 portfolio, where that's 60% of your portfolio in equities, 40% in bonds. If you run that portfolio through this similar analysis, you come up with something like 99% of the contribution to volatility comes from equities, even though they're 60% of the portfolio.
Mr. Chair, this is one of the reasons I asked my previous question when I look at the contribution of volatility for the credit portion, it's greatly mitigated relative to its allocation percentage. And yet the private credit portfolio is probably a little bit closer to a high yield bond index than a treasury bond index. There's a more of a economic impact component to it than say a treasury portfolio. So I was taken aback a little by how much the volatility of the credit component is diminished in light of the private credit holdings. Can you help me with that intuitively a little bit?
I mean, I think a big part of it is just from the strong cash flows from the private credit portfolio, kind of lowering the duration of the asset class. And so we might see some, I don't know, valuation volatility at times, but I think it's overall just a steadier asset class because of the cash flows we're getting out of it.
So that would be manifested in the return series in the past, say, 10, 15 years?
Yeah, because again, this is like this slide, the previous one on correlation is based on our portfolio, not on like proxies and benchmarks.
All right. Well, I just, point being that the asset class hasn't really been tested in a tough environment, arguably, except for COVID, but, you know, going back to an environment like 08, 09 or, so is the volatility number there an artifact of recent experience? Is that something prospectively we might?
So it's, I made note of this because it's even sometimes confusing to me. So MSCI estimates of asset class correlation, and this is for correlation, but this kind of applies to the volatility. So it's a forward-looking number. But it's weighted historical daily risk factors where more recent returns are weighed more heavily than older returns, and the half-life of the look-back period is 3 years. So, and there's some wonky formulas, but that's, so yeah, so it's forward-looking, but based on history, and again, the more recent history is weighted more heavily.
So what do you think of that?
I think they have a very large team of smart people working on it, but no one can predict the future. And I mean, with private credit, if you're worried about things going wrong, you rather be at the top of the capital structure and be in line to get your money back before the equity side. And so I think one thing that's pretty unique with our portfolio, so I've seen with a lot of other pensions that have a similar amount of private assets, they seem to have a lot more private equity, where we obviously have a lot more private credit, which is kind of a shorter duration asset class because you're getting more of those cash flows early. And then in a crisis, if a company does go bankrupt, you're more likely to you're going to get your money back first before the equity guys are. So, you know, the private credit is not, I mean, things can go wrong different places, but it's not I don't know, as concerning as maybe other areas could be. That makes sense.
One comment, if I may. So Robert mentioned earlier in your tip. One comment. Robert mentioned earlier, a 60-40 portfolio, 60% equity, 40% fixed income would have 99% of the contribution to volatility coming from equity. So if you think about that, 40% allocation to fixed income really wouldn't show up on this total volatility contribution. The fact that credit, even as that 6%, greatly mitigated from its allocation, it's still diversifying the total volatility contribution. So that's the only comment I would leave you with. So it helps. It does diversify. It's one of the reasons we a few years ago went from a Bloomberg aggregate benchmark and strategy in interest rate sensitive to just treasury, because we were taking the credit risk in this credit portfolio.
And then I'm going to go out of order. Can we go to page 113?
Actually, Robert, one question, just following on trustee Conley's question, just trying to wrap my head around this. I think what I understood your response to represent was that on the credit side, really you're measuring, this is volatility in NAV, right? Net asset value. And NAV is driven as a function of, or I guess it's volatility in total returns, which is driven by price return and income return. So for income return to be impacted, you'd have to have a default and a non-payment of the contractual revenue streams between the debtor. And then for price return or underlying asset value to be impaired, you'd need the enterprise value to drop below the kind of, from a capital stack perspective, whatever the equity is invested down to below to the implied value of the debt inside the organization. Said differently, you've got a bigger cushion or margin of error on this debt, on these debt deals. And that, I think, is the explanation for why the volatility is reduced. But to trustee Conley's point, that doesn't presume the global shock like 2008 where everything was impaired, right? So did I understand that right? I'm just trying to I think he asked a very good question. I'm trying to understand the response.
I think we're saying the same things, and the fact that, you know, the volatility contribution didn't go to zero kind of captures what you said. Like in a crisis, like there's still going to be some downside and risk here, but it's not dollar for dollar the same.
Because you've got that equity buffer from a price return perspective, and you may have some exposure on an income return perspective if they have trouble making the debt service payments. But that's, you know, they have to be in significant trouble to get to that point, right? The underlying debtor. Okay.
And then I'll jump to 113 to sort of stay focused on this. So this is usually the second slide in the stress test scenario slide set. But here is where we zoom in on the contribution to return from both credit and interest rate sensitive. And it's contribution to return, so it's not how that asset class performed. It's how its performance impacted the total portfolio, if that makes sense. So like in the first one, in the subprime and credit crisis, where credit says 0.93%, that doesn't mean credit returned 0.93%. It benefited the total portfolio 0.93%. Which, you know, so positive contribution to the portfolio, even in that terrible time, sort of showing that, you know, there's a lesser contribution to volatility than its dollar invested amount. And I don't know if this helps or confuses things. But.
And again, here, credit corresponds to our actual holdings rather than an MSCI constructed.
Okay, now I got trouble for going out of order. So this is our current portfolio as of 6/30/2025, but basically like the factor shocks from these past stress scenarios. So this is not how our portfolio performed, you know, in 2008.
Yeah.
But, you know, as today's portfolio, if those same shocks had happened, this is how we think it would have performed. But yeah, but based on our actual portfolio today.
112 of 136.
Yeah. And again, this is how hypothetically, how today's portfolio would have performed in these past stress scenarios. And then the excess performance versus our benchmark is a combination of sort of our actuals versus what's in the benchmark, and then our deviations from the asset allocation targets in the benchmark. You know, so the differences with like, you know, if private credit is at 24 versus 22, that would show up in these differences here. Any questions on these two? And apologies for jumping around.
I actually have a ton of questions on this chart, but I'm gonna leave those to when we have a more in-depth discussion.
All right. And maybe this won't help either to say this, but if we used a different risk system, all the different providers of systems like this have slightly different definitions of the crisis periods, like when they started, when they end, and they'll use a little bit different shocks. So if we ran our same portfolio through someone else's system, we would get a slightly different number. But again, predicting the future is very difficult. So it's not to say like this is exactly what we think would happen if the same scenario came up, but it's, I don't know, directionally correct.
Well, and applying it to the past also isn't an exact science either, right? Because like you said, you can't really apply our portfolio to a time in the past. So even then, it's still a bit of a alchemy, right?
Yeah, there are many complicated formulas, but it's more art than science.
There you go. Yeah, right.
Right. Move on to 115, please. And this is similar to a chart that Cole had on our public equity exposure, but this takes a look at our 20 largest global issuers for both stocks and bonds. And so that's why you'll see United States of America is our largest exposure here. That's from our treasury portfolio. And again, in the previous report, Apple was our largest equity holding, not NVIDIA. I will say that having 15% in our top 20 issuers is the highest or tied for the highest that I've seen since I started doing these reports. Usually it's like around 13 or 14% in our top 20 issuers. And then I'll go.
That's really just a function of the Mag 7.
Yes.
Appreciation. Yeah. Yeah.
Yeah, but unlike if you're just looking at the S&P 500 or the MSCI large cap that we use, this pie chart would look a lot different. So it's, it's the impact of the Magnificent Seven, but obviously a much smaller slice because of our large global portfolio that's well diversified. And then on page 116, this is just showing our public market managers, and as you'll see, has been discussed earlier, we are our own largest manager, and then we have two other managers for non-U.S. equities and a little bit of our interest rate sensitive exposure. And has been mentioned before, these are all kind of enhanced index based portfolios. And then on page 117. I'm just showing our largest private investment managers by asset class. And you'll notice the kind of more concentrated exposure to managers in private credit and real estate, where we have the fund of one and the more custom structures. And then our co-investment program with JP Morgan sort of in a positive way jumped up to the top of that ranking. It's a newer program, but I think this is helpful overall to our private equity investments, having this partnership that has pretty low fees compared to standard funds. And as you'll see here, it's obviously our largest private equity investment manager, and so it helps us overall in the portfolio lower the fees that we're paying in private equity land. And then on 118, I'll just go quickly on this one. Same private managers, but grouped them because, as you'll see, we've got a few managers that manage private investments for us in a couple asset classes. And obviously with Related being the largest. So these are kind of the managers that I like to pay more attention to, if you will. And then 119 is bringing them all together with our largest managers for both public and private assets. And, see BlackRock there as our largest external manager. But again, we are our own largest manager, managing around 32% of the portfolio. So significantly more than our external partners. If there's no questions, I'll move on to the compliance report.
No questions here.
All right, on page 122 on the summary, as you'll see here, I'll go over the pre-trade compliance system, our custody banks compliance system, and our private markets. I guess the quick highlight is there were no major red flags or areas of concern, both during the time period covered from the report and since putting this report together. And on page 123, briefly on the pre-trade compliance system, basically our order management system in Bloomberg, we have guidelines built in that prevent issues like fat finger trades where, you know, if you slip and hit too many zeros or try to buy something you're not supposed to buy, the system will stop that trade from going through. So it's, you know, starting the beginning of the process with compliance. And there were no pre-trade compliance issues during this time. And then I'm going to go ahead and jump to page 125. Just say, so in addition to getting a daily compliance report from BNY, who's our custody bank, and I get a monthly compliance report, I can also see our portfolios in Bloomberg, and I'm in pretty regular touch with the portfolio managers on both the public equity and the interest rate sensitive side. And usually if something pops up, it tends to be like around a index rebalancing, where sometimes it's almost like the public-private performance reporting where there's a lag. So one day something may get flagged because it's not in the index, but it actually is in the index. So then it's no longer flagged the next day. But like the equity team will give me a heads up saying, hey, there's a rebalance coming up. So some things might show up, and I don't get alarmed when they show up because then they all go away the next day. But so lots of oversight, both, and like I said, communication with the internal team there as well as the bank. And let's see. I'm going to go ahead and jump to page 128. And so our custody bank, again, BNY Mellon, they do a monthly review of our portfolios to make sure we're following all of the Arizona mandated laws we need to follow in regards to our portfolio. And there were no concerns flagged between May and July of this year. And just would note that the previous report covered February through April. And again, no major concerns there. And then maybe a little added color, in addition to sort of restricted things that they look for, there are also some informational only flags that I get that aren't concerns, but just sort of things to keep an eye on, like our use of futures, which is not a concern, but sort of nice to know. So we're watching more than just what's mandated by the Arizona statutes. And then if no public market compliance questions, I'll jump to the private markets on page 129. So RCLCO is our real estate consultant, and we also have them do a review of our real estate investments in the separate account fund of one type structures. And basically they're just double checking the calculations from our partners there, and then reviewing all of their policies and procedures to make sure they're consistent with ours. And page 130 is the update on the compliance system or compliance review. Again, they've completed the 2022 reviews. The 2023 are in process, and they actually had sent me some more reviews since I put the slides together. So as of September 16th, the count of reviews stands at 14 completed and 8 remaining for the 2023 reviews. And one difference to note in the RCLCO reviews versus the Makita that we're getting to, RCLCO reviews every real estate separate account fund of one structure every year. So their reports are shorter because they're just looking at 1 year of information. And then we'll switch to page 131.
Robert, quick question before you do that. Why are we so far behind in arrears on that?
Well, so there's 2 to 3 reasons. So one of them is because of the reporting lag in privates, the compliance review of the reporting is even more lagged, if that makes sense.
Yeah.
So they can't start till long after the year has ended and everything else has been completed for the reporting. And then there's also just sometimes a lag in getting the information from the partners. Additionally, when this program was started, there was like a 2 to 3 year look back to get going. So it's always been several years in the past, if that makes sense.
But I guess if we're reviewing now 2023 results and we found something, what would happen? Right? I mean, if we're, if we're in October of 25, right?
Yeah, if it's outside the sort of the acceptable band of a mistake, we could go back and try to get a refund from the manager, and then also do things like look at correcting policies or agreeing to new policies going forward to make sure the errors don't happen again. Since I've been here, there haven't been any major errors found, or areas of concern yet, so that's encouraging. And then again, the Makita reviews are usually even more lagged, and that's partially because we have so many private equity and mostly private equity investments and private credit. So they do a sampling process on their reviews. So they're maybe doing 30 to 35 reviews a year. And when they're reviewing a fund, they'll go back to any previous years that haven't previously been reviewed. So RCLCO is just doing 1 year at a time. Makita could be doing, I don't know, maybe up to like 6 years worth of reviews on one review.
Okay, I got it. So this is this is an internal compliance control that is just good hygiene. It's not, we're not doing this Makita on every year for all the assets. They're going back and looking at a manager and potentially taking back multiple years just to validate and determine or ensure compliance for that specific manager. I guess that's why do that? Why go back 5 or 6 years? I'm just curious as to the approach, versus why not do it just every year currently versus going back 6 years. What's the thinking on that?
Well, so on the Makita reviews, again, they're doing a sampling process. So they maybe have 300 investments they could look at.
Yeah.
And so they're not doing 300 every year. They're doing 30 to 35. But that's why they go back and do multiple years, so they don't want to miss a year that hasn't been reviewed.
I got it. Okay.
And this process started at the suggestion of our external auditors.
Okay. All right. Thanks.
So I guess briefly on 131, basically Makita is doing a similar review as RCLCO does, but on our private equity and private credit for the most part. And as mentioned, it can be a multi-year review. And then in addition, I think I said this maybe, but in addition to double checking calculations, they're also reviewing things like their expensive policy, their valuation policies. And so it's not just a double checking of the numbers.
Okay.
And then on page 132, and this one will take a little bit more explanation. So for the 2020 period, 38 completed, 1 fund to go. They've also completed all of the 2021 reviews, and 2023 are in process. So it may look like we skipped 2022, but because they go back and do years that haven't been reviewed, we felt like they weren't really skipping a year. And we kind of wanted to get closer to the present period as much as we could, despite all the, lags and closing the books, and then having to get the information after the books were closed. And I hope that makes sense. And again, part of this is because when the program was started, they went back several years. So it's never been a, like, we're just reviewing the most recent year.
I guess I don't want to burn a whole bunch of time on this, but it would seem to me that it would be far more logical to do 2023 for 200 sponsors versus going back to 2020 for 30 sponsors and going back, you know what I mean? Like, I'm struggling with what's the benefit of going back deeper with less review, reviewing less sponsors, but I don't, there's no action. I don't need you to answer a question. It's just puzzling to me. It feels like an auditor, like an auditor request that is just, it's strange. I don't understand, but there's nothing for you. I don't think you can make me understand, I guess is the point.
Well, I guess I would just say again, this came as a suggestion from our external auditor, and I am not an auditor, but they like to do sampling processes. So I think that's partially how we ended up with, of all the funds, we're going to pick a sample to review. There's also a cost and time aspect of reviewing 300 investments versus reviewing, 30 at a time.
Sure.
Mr. Chairman, question, I'm curious. You said they went back 2 to 3 years. So are they slowly catching up because they went back? And does the auditor also know that they're this far behind, or the group that suggested we do this know that they're this far behind?
To the best of my knowledge, the auditor has never brought up a concern with this process after it's been started. And I think the auditors would also be sympathetic to the lag due to how long it takes to get the information and, when the private investments close their books and that sort of thing.
So, Mr. Chairman, as a follow-up, so does this mean, so I guess, so Robert, so when it's all said and done, are we gonna have, these samples, I guess? Will we have Makita, will they do information from 2020, 2021, 2023, 24, 25? Will 2022 be the only year with no data?
So there's not going to be a, so-called 2022 review.
Right.
But in the 2023 review, all the funds being reviewed, they're going to look at 2022. And
all right, Mr. Chairman, I'm with you now.
well, they'll go back to any year that hadn't been reviewed.
Gotcha.
And then,
but it won't officially be a 2022 review.
Magical time in the future, as this process goes along, we're shrinking our number of private equity managers and more concentrated portfolios. So there won't be as many to review, and also because there's been so many years when they've gone back multiple years. Each new year, there's fewer years to go back and look at. So in the beginning, maybe you have to go back 8 years, but then then you only have to go back 7. And so as the process continues, it'll be a shorter.
The look back shrinks.
The look back shrinks because everything's been looked at.
Gotcha. Okay, I think it's starting to. Okay, thank you.
What you're doing is insurance compliant. You're ensuring compliance by sponsor. And to do that, you're going back multiple years to get a perspective, because it's a lot easier to do one sponsor over 5 years than 5 individual sponsors for 1 year. I think that's probably the right solution, right? And
yes.
Okay, that makes more sense. Thank you.
Each year, you're selecting a new sample of sponsors to go do the compliance check on. Now I get it.
To eventually capture everyone.
Yes.
Okay.
And I
gotcha. Okay.
And I work with Makita too. Some on the they do the sampling, but we have back and forth to look at, okay, here's a larger investment that we haven't looked at recently. We want to include that versus, hey, we just made this investment, last year and we have a very small allocation. That's not a high concern. So it's not a totally random sampling process. There's a focus.
Okay, that's the thing. Yeah, it's sort of lead driven sampling, not random sampling.
Yeah.
Okay.
Robert, we feel like over the last year or two, you might have thought we weren't paying as much attention. So we really wanted to do a deep dive on the compliance section this time around, particularly as the inaugural experience for our 2 new trustees on the investment committee. So I think you've answered all of our questions thoroughly and appropriately.
I have one more, Mr. Chair. Sorry.
Yeah.
No, I think this is great. I'm glad the auditor suggested it. It's kind of an extension of other third-party people looking at what we're doing internally, so I really appreciate it. On page 130, third bullet, RCLCO's review found immaterial inconsistencies related to their activity. Okay, that's great. When I go down to page 131, Makita has been doing something similar on the other private investments, but there's no conclusion here. It says a summary report will be presented to the ASRS to communicate on findings. So there, to this date, have there been no findings? Is this a process that it was just begun recently?
You know, I need to adjust that bullet point. Thank you for bringing it up. Their findings have been similar to RCLCO, where it's like they maybe have a 50-cent or $5 difference here than there, but it hasn't been anything material like, oh, we owe them or they owe us a large amount of money. So I need to amend that bullet point, but they do, I mean, they do send all the reports on the individual investments and then also a year-end summary.
Okay, so on 131 and 132, basically there's been some activity, but there's nothing material to tell us.
Correct.
Thank you.
And I worry about many things, not because of us, just because that's who I am and my job. This is not what I worry about a lot. If that makes sense. And again, these are investments that our internal staff looked at before we made the investment, our outside consultants reviewed before we made the investment. So this is just an additional double, triple checking of things. Right. Thanks.
One comment, Mr. Chair, if you will, from a governance perspective, Robert does not report to the CIO. He reports to the director. So different line, right? So I can't tell Robert, change that risk report. I don't like it. We work together well, just like NEPC is the board's consultant, where we have an amicable relationship, a good, healthy, professional relationship, but the reporting line is different. So I just want to make note of that.
Helpful, thanks. You could tell him that, but he just may not do it, right? Thank you. Was that it for Robert? Is that everything?
I was hopeful that was it.
Thank you. Thank you.
To answer any additional questions. All right.
None here. Any from the rest of the investment committee? With that, we'll move on to item number 6, which is a summary of current events. I don't have anything, but Mr. Mattson, anything?
No, nothing to add. Thank you.
Okay. Let's see. Call to the public. Do we have anything?
Chairperson, oh, sorry, Chairperson Pacunas, we do have one member of the public wishing to speak.
Okay.
Those wishing to join us up front to speak will come up here. Please give us a moment to set them up.
Thanks.
The members of the public are ready to speak. I will now read the guidelines for speaking. Public members will need to introduce themselves prior to addressing the committee. Public members addressing the committee will have 3 minutes to speak. As a reminder, trustees of the committee are limited to discussing matters on the current agenda, responding to criticism, directing a matter to staff for review, or asking that a matter be placed on the future agenda. Chairperson Pacunas, would you like me to introduce our speaker?
Yes, please.
All right, we have Mr. Michael Fenney.
Thank you to the chair and members of the committee. My name is Michael Fenney. I'm here on behalf of the Private Equity Stakeholder Project, a nonprofit watchdog for the private equity industry. The Arizona State Retirement System is an investor with the private equity firm Thoma Bravo, which owns RealPage, a property management software company. According to the Arizona Attorney General, Chris Mays, in the last 2 years, residential rents in Phoenix and Tucson have risen by at least 30%, in large part because of RealPage. As of today, ASRS has invested $150 million into the Thoma Bravo funds that own RealPage. Since 2022, there's been a growing movement against RealPage due to accusations of sharing private tenant information among competing landlords to determine rental prices. In a letter to Attorney General Bondi urging the Trump administration to continue the lawsuits, Arizona's AG stated that, quote, RealPage and its co-defendants must be held accountable for their role in the astronomical rent increases forced on Arizonans, unquote. RealPage is the subject of over 30 class action lawsuits, along with lawsuits by the Department of Justice and a bipartisan group of state attorneys general. These lawsuits accuse RealPage of collusion and creating a housing monopoly that negatively impacts tenants across the country. It has also transformed the housing market, meaning that landlords who no longer use the software or its recommendations are no longer competitive. RealPage has been the subject of over 44 pieces of proposed legislation across 22 states in the most recent session. Additionally, RealPage and similar software have been banned in major cities such as Minneapolis, Seattle, San Diego, Philadelphia, and San Francisco, with more cities continuing to pass bans. We believe that the Department of Justice lawsuit, bans in major cities, the proposed state legislation, and the outpouring of negative press about RealPage could have a negative impact on returns for pensioners. We believe that the costs from the litigation against RealPage could have troubling impact on returns as well. We are asking you to halt all future investments into Thoma Bravo until RealPage removes the rental price sharing component of their software. And we are also asking you to meet with Thoma Bravo and ask them how they plan to reduce the financial and reputational risk to RealPage. Thank you for your time and consideration.
Thank you. Are there any other members of the public who would like to speak?
No, that was it, Chairperson Pacunas.
Thank you so much. Okay, with that, we'll move on to item number 8, board member or executive director requests for future agenda items. Trustee Connolly, I heard you identify an item that might be worthy of discussion. Would you like to formally agendize that for future meeting?
Yes, Mr. Chair, if you can remember what it was.
Let's see. I think we were talking about we were talking about the choice of our benchmark index and the impact on broader strategy versus monitoring our performance relative to the new benchmark.
Right. Thank you for, yeah, that would be the
And the opportunity cost and kind of moving out of public.
strategic perspective view of opportunity cost to a more operational view of efficacy of manager selection.
Mr. Connolly, would you maybe like to work with staff offline to more thoroughly vet the items so that they have the clarity they need to create a discussion item for us in one of our next meetings?
Be happy to, yes.
That'd be great. Okay, so why don't we let that discussion happen? And I don't know, for the record, do we need to formally add an item to the agenda now, or should we wait until we have that discussion? Someone.
Yeah, no, we do not need to. I've already got a note of it. And basically in broad terms, it's going to be presentation discussion with respect to both opportunity cost benchmarks as well as asset class benchmarks, and then an in-depth discussion of the pros and cons of using different benchmarks for those two categories. So yeah, I think we've got a good conceptual understanding of the agenda item. Thank you.
That's great. Thank you. Okay, any other future agenda items that anyone would like to add? Okay, the next meeting, so agenda item number 9, the next meeting is scheduled for December 15th at 9:30. And we will now come to item number 10, a formal adjournment.
Chairperson Pacunas, correction, the next meeting is scheduled for December 17th, 2025 at 9:30.
What did I say? Sorry.
Said the 15th.
Oh, sorry, okay. Then please let the record reflect the correction. And with that, do we have a motion for adjournment?
You do not need a motion to adjourn.
Then the meeting is adjourned. Thank you.
Thank you, everyone. The time is 12:09.
All right,
You're good. Thank you, everyone. Thank you, Chairman Petrunas.
thank you. Take care.